Hello traders, Gary Wagner here, just about 11:40 in Honolulu, 4:40 in New York. It is Friday. Happy Aloha Friday, as we say on the islands. It is March the 10th, 2017, and this is the Daily Report for gold and silver, our weekend review. And what a week we have seen. Gold suffering some tremendous losses as the Fed gets closer to an interest rate hike. The anticipation of a jobs report, of course, is over, with numbers being released exceeding expectations today, with new jobs added last month at 235, estimates at around 190,000 new jobs added. And that pretty much seals in the certainty of an interest rate hike next week when the FOM meeting begins on March 14th. Gold recovered slightly. It is trading up about 70 cents on the day, 90 cents, as you can see, just settling right now, currently trading at 12.04. The low, though, 11.9450. We've had some volatile swings in the high, 12.06, just a couple dollars off the highs, but you can see we've had some gyrations in the market, to say the least. When we look at silver, silver's trading up, or fractionally unchanged, I should say, but it is above $17, the low 16.85, and the high on the day has been 17.10. Now, it's kind of been a contrarian day in that once the jobs report came out, the factoring in of the inevitable rate hike next week seems to kind of teetered away a little bit, so to speak. And so you've got the dollar trading now under pressure at 101.32, off about 0.5% on the day. So traders, in anticipation of a rate hike next week, and that almost set in stone with today's jobs report, we now have the second week in a row in which gold has sold off sharply, even though it did recover today and trade to a low of 11.94, which is a low on the week, but did recover well over 1,200 at 12.04. You can see that the high this week was 12.36. The low we just talked about was 11.94. That's a significant number. We'll touch on that in a second. So we had a tremendous drawdown now for 2 weeks in a row. And the question is whether or not, at this point, gold pricing has fully factored in a rate hike of between 75 and 100 basis points, which is where that high probability falls into. Now, as for the low, and one of the reasons that I believe we could be looking at some real potential support. We have talked about this all week, but we talked about a harmonics that is present in this particular market. In this case, a 50% retracement and a 78% retracement, 1194 to 1198. And so that's a pretty significant area that we believe should be an area that we want to look at for potential support. A break below this price point, which it did not do, but a break below next week would certainly indicate that the market's going to 1180. However, real support and a bounce above this would indicate that we have possibly weathered the storm in this market and are looking for higher pricings. But with next week's FOMC meeting, we're going to see some increased volatility, but nonetheless, in terms of what we have seen this week and the tremendous sell-off, it does appear as though we have the first signs of a recovery. Doesn't mean there will be a recovery, but we are seeing the first sign. And traders, it becomes much more clear in terms of the first signs of a recovery when we convert our weekly to a daily chart. That's what I've just done. Interesting formations that we have noted, this triple top, meaning 3 dojis in a row. It's significant. I haven't seen a formation like this. There is a formation that's called a tri-star, in which you have 3 dojis, but they appear like this, these being the real bodies. And you're not getting that. You're getting consecutive lower lows and lower bodies in that. You're also seeing that 1, 2, 3, 4, 5, 6 consecutive candlesticks in a row were red following that. Today's being the first real sign of potential support in the market. And then also we talked about this key level at 1194, which turns out to be precisely the low that we have seen gold trade to this week. So we will go into the week flat with no active trades, take a look next week, and probably not put any kind of a trade on till after or the conclusion of next week's FOMC meeting. Starts on the 14th, concludes on the 15th. And traders, then lastly, in terms of looking at gold today, I've pulled up a half a day, 720-minute Japanese average chart. I started with the daily charts, but the daily charts showed no clear sign of a potential end or conclusion to the current sell-off, I should say. When we go to a half a day average chart, we do see that because we get the first signs of an upper wick and a small body. Now realize a Japanese average chart, by the nature of that chart, is always going to lag behind. It's going to be a lagging rather than a leading indicator. So we wouldn't expect to see it here first, but I do look at this in terms of confirmation once the pivot point has happened or a trend has actually reversed. You can see that, such as here, you've got these very, very strong green candles, and you get this doji-like candle right at the top of the market. Color switches, still small-bodied, then it ramps up. You can see it builds steam here, consolidates, and then very, very solid downside moves here up until the conclusion or the last candle coming in. And so that's another reason that we could easily be witnessing some sort of support coming into the market. So traders, what about silver? We haven't really looked at it in a while. We're looking at a simple daily chart, standard bar chart format. It does have the MACD, which is certainly alluding to lower pricing. You can see that they are moving apart and they have broken to the downside. When we look at the basic fib retracement starting from 1567, which is the low achieved right before the major rally this year, up till 1850, and that of course is the high achieved mid-February. It's really the 61.8% retracement that I'm looking at 1675. I think that is where we will find support in silver. Dow Jones Industrial Average also had a tough week, but a small recovery, now back over 20,900 to close at 20,902, putting it up about 44 points, a net change of about 0.2%. S&P in line with that, up about 0.3% at 2372, and then the NASDAQ, that trading up about a third, almost 0.4% at 5860. Now, the slide that started in crude oil continues, broke through 50 the other day to 49. Now it's at 48.42. As you know, we are on record looking for $48 per barrel. That's where I think we'll find the first potential level of support in that market. We are looking at a daily chart, standard candlestick format of the Dow Jones Industrial Average. And we have been talking about the fact over the last week that we have truly seen a price void or a gap as the market gapped above 20,800 to about over 20,900. Once this gap was in place, a technician tool simply states that that gap is going to get filled. And that is what my assumption was predicated upon. And we certainly saw that, as you can see, over this trading week, especially yesterday's low coming in and filling that gap. These days have been interesting because they're very, very small bodied. We really want to look at it on a weekly basis. But in essence, we have seen this gap filled. So the question becomes, well, where to now that that's happened? Well, the first thing we've got to ask ourselves is whether or not the equities markets has factored in a potential rate hike. Well, we probably have, and that by virtue of the fact that we saw a recovery today and the markets, the majority of the index is closing higher. But when we look at a weekly chart, what we're seeing is a distinct difference between what has occurred over the last 5-6 trading weeks, and that is we no longer have this upward trend of solid green candles with nice body size. In fact, we have a slightly lower close on the week, and we also have a star-like candle forming in the mid-range of the prior candle. That would be a 2-day pattern. It's one of the weaker key reversal bearish patterns, but it's simply called a bearish harami. Obviously, on a bearish harami, the Western traders call that an inside trading week or an inside trading day, but that would only be predicated if you had a confirming candle. Now, a confirming candle for this particular pattern would be that next week, we would have to see a pretty sizable drop, meaning a large red candle with a lower low and a lower high. It would look something like that, and that would issue on a technical basis the fact that the market is probably going to retrace. And of course, traders, the really big news was a utter crash of the crude oil market. This based on a glut in terms of supply, and it's an obvious supply and demand equation. There's a lot more oil out there than people are demanding or needing. Now, the characteristics of crude oil over the last couple of months, just prior to this drop, was a tight and narrowly defined trading range. And you can see over the last 3 days, we have seen this market lose an incredible amount in value, coming from about $53 a barrel and now trading to just above $48 per barrel. Traders, absolutely no doubt. We have seen 2 weeks of a tremendous sell-off in precious metals, specifically gold. Gold 2 weeks ago was at $1,265 per ounce. It has come down hard over the last 2 weeks in double digits each week, closing this week at about $1,204. The question we must ask ourselves, is a rate hike fully factored into the market, and will gold find support at around 1,200? Because as you know, 1194 to 1,200 is an important fib level. It's also an important century mark. Based upon that, I think that there is at least a 60 to 70% probability that the market will form a base and support at 1,200. This has been Gary Wagner, wishing you, as always, good trading. Have a great weekend. We'll talk to you on Monday for another daily update and review. Bye-bye.